What's going on, everybody? Thank you so much for checking in. In this video, we're going to go over SPY, which is the S&P 500 ETF, and we're also going to go over our watch list for the next week. This watch list includes names like Meta, Google, Tesla, Microsoft, and Netflix. So if you haven't already heard, so many stocks are already making new 52-week highs. That means they are making a new high for the last year. These stocks include names like Meta. Meta, this is the highest it's been in the last 12 months. Same thing with Microsoft. In fact, it is at an all-time high right now. And names like Starbucks also reaching a 52-week high. McDonald's also reaching a 52-week high. So you're starting to see these stocks really peak, and the market is starting to take that confidence again to go up. So we do expect the market to keep going in the next few weeks. However, there are some very important events that are happening this week that we need to talk about. That way we make the right projections accordingly. So before we get started and jump into our watch list, let's go ahead and talk about SPY. We can see that for the last 12 months or so, SPY has been making lower highs. Up until 2023, we can see that we broke out of this trend line and we got rejected right below 420, came back down to that trend line, and as bulls wanted to see, we dipped just below it, but you can see that buying action started coming in and we bounced right back towards 420 last week, ending the week with a very strong 2-day rally that took us back towards 420. So what's going to happen this week? This week is a very important week because we have something called the FOMC meeting. So the Federal Reserve will hold a 2-day meeting starting on Tuesday, and they will decide on the next interest rate hike. So as you guys have known, or if you don't know, since the start of 2022, the Federal Reserve has raised rates about 8 times. And higher interest rates are typically the kryptonite to the stock market rally, because anytime a market is rallying insanely, it's usually because of low interest rates. So for example, back in 2020 when the stock market took off and it rallied for 2 years straight, this was a time in which we crashed because of COVID. The Federal Reserve dropped interest rates to zero, and when it comes down to zero interest rates, when money is easy to get and cheap to get, then growth is easy to get, because tech stocks, for example, rely heavily on borrowed money in order to grow. And if money is easy to borrow and it's cheap, then growth will happen at a very rapid rate, which is exactly what we saw from 2020 to 2022. Until the Federal Reserve stated that they will be raising interest rates, which happened in November. You can see that ever since then, the market has been pulling back, and we're finally starting to calm down and create the new highs. In fact, in all of 2023, we have not made a lower low, which is a fantastic sign. So something you got to remember, when the market is recovering from a crash, it rarely ever just goes up vertically. If it does go up vertically, it eventually means that it will come down just as hard. So now that we are finally getting some relief because of tech earnings. So Meta reported earnings last week. They beat earnings. Microsoft beat earnings. Netflix almost beat all of its earnings. And then this week we're switching over to Apple. That's going to be a big one. So last earnings, Apple actually missed sales estimates for the first time in 7 years. But regardless, the stock managed to go up. In fact, Apple is outpacing the S&P 500 by 22% this year. So what's going to happen this week? With the big focus around FOMC, we're likely going to come into this week, and Monday and Tuesday are likely going to be choppy. We did see a vertical rally on Friday and Thursday, which means that a pullback is due. If we go up tomorrow, which is Monday, or Tuesday, then we are likely going to pull back. There will be profit taking because people will be too scared to hold through the uncertainty of the interest rate hikes. So if the Federal Reserve decides to raise rates, it will be by 25 basis points. It is very unlikely that they will raise them by 50 basis points. In their last meeting, they did say that they are going to take a softer tone on future hikes, but we do expect at least one more rate hike in this meeting before they start pulling back and perhaps even lowering rates. But that's unlikely to happen until inflation cools down to their 2% target. So inflation has been cooling down for the last 6 months, and history shows that it takes about 9 to 12 months after the first Federal Reserve rate hike for it to start affecting the market and working out to the way that it's supposed to. So yes, we saw the Federal Reserve start raising rates in the beginning of 2022, which makes sense to why we're starting to see so many companies laying off employees and we're starting to see inflation cooling down. It's all because those interest rates are starting to take effect and do what they're supposed to do. It's supposed to slow down the economy a little bit. It's supposed to cause a little bit of unemployment because we need the economy to contract in order for inflation to cool down. Now, if you are looking at SPY and you're looking at it on the daily candles, we can see that last week's 2-day rally was accompanied with very, very strong buying volume. Since our rally started back in the end of March and we started going back towards the 400, we can see that we did not break below this blue line at all, which is the 10-day moving average. So buyers were very resilient until last week. We saw that strong dip, but it looks like it was just a shakeout and the market quickly got bought up. Perhaps it was a relief rally from strong tech earnings. And so now that we got bought up back above the 10-day and 20-day moving averages, if you are a moving average trader, then you will use those as your support points. You'll want the market to stay above those points for it to potentially rally higher. Now, if you're not a moving average trader and you like to look at the shorter term charts, which we always do when we're day trading or swing trading, here are some levels that you need to focus on. Now, obviously, 420 is a psychological resistance. This is the point that we need to break above in order for us to rally. And if we do break above 420, then we are likely going to see a very strong short squeeze rally that takes us to 425 and even 430. Now, this may not happen this week, but it is likely going to happen in the next few weeks as long as we're holding this 10 and 20-day moving averages and as long as we're holding the 403.70 support. Now, as buyers or as bulls, we do not even want to see SPY coming down towards 403.70 because judging by the rate that it came down to it last time, if it comes down to it again, then we will likely pierce right through it and fall below 400. So we don't want SPY to come back towards this level, but if it does, that is going to be a very critical support. Now, apart from that support, we also have a support between 410 and 412. So if we do pull back this week and it's around that level, then we would actually consider that a great entry. And then we would have our stop loss just below 403.70. We would give ourselves a couple weeks at least on those calls if we are planning to swing them. Now, if you are bullish and you don't want to play a pullback, you want a breakout play, you can wait for the 420 breakout. You would enter just above 420 and you would place your stop loss just below the 420 mark in the case that we break back below and fail the breakout. Now, moving on to our watch list, we can see that there are many companies that gapped up on earnings. Now, if you know our approach to the earnings gap ups, we have a very specific strategy on how to trade these. In fact, the strategy is included in our course. If you want to learn, it's plugged into our bio or description. So check it out. It's a great course. You'll learn everything you need to know about trading. In fact, you'll learn how to trade earnings, which earnings can be a very, very profitable approach to the market. So if you are looking at Meta, for example, let's take a look at their last earnings. You can see that they gapped up and they rallied all the way up until this earnings. So two back-to-back gap ups. The last gap up took Meta from a low of around 150 to a high of around 223, which is an amazing gain. So now people are wondering, is this going to happen again? So Meta's gap up this time took it to a high of around 241.70. In fact, in pre-market, it went to 242.27. So if we're looking at Meta and we're trying to construct a play around this here, let's go ahead and zoom in a little bit and talk about the gap. So this was the gap up, and looks like we have held the gap up so far. So when a stock gaps up on earnings, you want to see it holding that earnings gap up in order for it to continue. So far, it has held. It bounced at a low of 235.70. So if you are bullish, you're going to need to place a stop loss just below 235.70. Give it some breathing room. Don't place it right at 235.70. Give it some breathing room below that point. Place it a couple points below that point. And then if you are looking for a breakout, you're going to need to focus on the 242.27 resistance. Above that point, the next price target to take profits would be around 244.60. Not a very aggressive price target, and that's because we're just looking at it for a very short-term play. If it does break above 244.60, by that time we would have taken profits on at least half our position, and then the next price target is a lot more aggressive, between 250 to 253 to take profits. If the stock fails and it breaks below 235.70, then the next strong support will be around 231.60. Below that point, it can very much start filling this gap back down, and it could move at a very rapid pace. Now, the next stock on our watch list is going to be Google. Now, Google beat earnings. However, the stock did not react like Meta or Microsoft, and that's just because nobody really knows what a stock is going to do on earnings because there are so many moving parts. The company can report great revenue and great earnings per share, but sometimes the CEO or the CFO on the earnings call will say something that wasn't really favored by investors. Therefore, they end up being more uncertain or they end up selling the stock. So Google actually reported great earnings, and we do believe that Google is an undervalued company that's starting to show signs of a lot of strong buying and volume accumulation, and this could lead to a very big breakout. However, we don't know what's going to happen, so we always like to create levels and trade based on those levels. So let's take a look at Google here and talk about the levels that we wanted to see break above or below for us to take our plays on it. So Google here, we can see has been floating right around the same range. In fact, it has been creating this little cup and handle pattern and just consolidating to the right of it. So Google's large vertical rally, of course, couldn't last forever from this point to this point. It needed that point of consolidation before buyers are able to kick into gear again and take it higher. So last time Google floated around this for months, it came back down to a selling point. Here we're floating around it for a couple weeks, and we are expecting a breakout. So Google's breakout point is going to be right around 109.20. So if you are bullish on the stock, you can create a small position with a stop loss just below 103, and then you can add to the position once you get that breakout above 109.20, and then you're going to place a stop loss just below the 109.20 mark. Again, give it some breathing room. You don't want to put your stop loss too close to the support because then you may be shaken out. So if Google breaks above that point, the short-term price targets on this one are going to be 112 and 116. However, we do see the stock rallying all the way above 120 at some point. So if you're an investor and you're just looking to buy shares, this is a company that's worth buying right now, obviously, because Google is still very dominant in their space and they are going to gain that traction to break out. In fact, we're seeing the same kind of signs that we saw in Nvidia before it went on a multi-week rally. So pay attention to Google. That's a very, very good name to watch. Moving on to Tesla, we can see that Tesla reported poor earnings. And just like stocks that report great earnings and gap up, companies that report poor earnings are going to gap down. So Tesla gapped down on earnings, and the stock came down to a low of around 152 at some point last week. Here are some levels to focus on. But before we move on to the levels, let's talk about the moving averages here. So anytime we like to enter a bullish trade on a stock, we typically like the stock to be trading at least above its 10 and 20-day moving averages. We can see that that's not the case for Tesla. In fact, it is trading below all of its important moving averages, which are the 10, 20, 50, 100, and 200. The 50-day moving average is what institutional traders use. These are professional people in order to gauge if a stock is in a bullish trend or in a bearish trend. So right now, Tesla is starting to lean more towards a bearish trend. But if the market continues to rally like it did last week, then we are likely going to see any stock that's being held back start to catch up and move higher. So here are some levels to focus on for Tesla. If you are looking at it for a bullish trade, you're going to need the stock to break back above 170. So resistance last week that was created was 165.65, but that's not enough. We want to see the stock back above 170 for us to take a potential call position or a long position towards a price target around 176. Second price target would be 184. That is a very aggressive price target, so I wouldn't plan on that happening this week, perhaps in a couple weeks if the stock holds 170. Now, if the stock continues its downtrend and breaks back below 160, then a short or a put position is possible to 152 to 154. Second price target to the downside, if it breaks below 152, would be 146. 152 is a very critical support because you can see that we bounced right at it last week. And the stronger the bounce from the support, the more significant that support becomes. The bounce off 152 took Tesla all the way back to 165. So if buyers let go of 152, the stock will fall sharply. Next stock on our watch list is going to be Microsoft. Now, Microsoft, another massive upside move after earnings. This is a company that has been rallying all of 2023 and for great reasons. Obviously, Microsoft is a fantastic company and they are only doing great things. So Here, Microsoft, we can see, has been dominant, especially in their involvement in the AI and open AI sector. We can see that Microsoft reached a 52-week high, got pulled back right around 309 last week. If we look at the weekly candle, which is even further out than the daily candle, we can see that last week's volume was insanely high. Microsoft has had many of these weeks over the last couple months. We can see that here. This week's volume was massively strong on the buying side, once again repeating that pattern. So we could be seeing a continuation from Microsoft as long as markets stay healthy. So Microsoft's levels to focus on are going to be first, the 309 breakout. We're calling this a blue sky breakout because it's a 52-week high. And then above that would be around 314 to 315 is your first price target. Now, if Microsoft fails and breaks back below 302, we will not be shorting or taking a put on this position, only because Microsoft's break below 302 is likely just a pullback. We wouldn't really be worried or playing a downside move unless Microsoft moves below the entire gap up. So the gap up that happened here took it to a high of around 300 initially, came down to retest 292. So if Microsoft breaks below 292, then we would consider a short or a put position because then it would have failed the entire gap up. Last but not least, the final stock on our watch list is going to be Netflix. Now, Netflix, their earnings weren't so exciting. In fact, the stock barely made a move at all on earnings. We can see that they reported earnings and then they stayed flat. However, the stock has been quiet for some time. If you guys have seen our videos over the last few weeks, you know Netflix has been on our watch list, but it still hasn't given us the move that we want yet. But we're still watching it because Netflix is very much known to make very, very rapid moves the moment it breaks out. So we're waiting for that breakout, and here are the levels that we're focused on for Netflix. Our price targets on it were a little bit more aggressive last week, but we're kind of taming them down this week. Primary reason is because of the Federal Reserve meeting. It is unlikely that we see the market make massive upside or downside moves. If it does, it'll be closer to Thursday and Friday. Now, the resistance on Netflix to focus on is going to be 331. Price target above 331 is going to be right around 334 to 335. Above that point, we can see a price target around 339 to 340. Now, if Netflix fails and breaks back below 324, you can potentially take a short or a put position down towards 316 to 320, but bears won't really step in until we see it break below 316. Now, this breakout and price targets are not the overall breakout on Netflix. Netflix will need to break above 350 in order for it to take on a full rally, but that's on a multi-month projection. We are just doing a weeks out projection. So I hope you guys found this video helpful. Thank you so much for checking in. Please don't forget to subscribe and like.